All right, everyone, let's get started. This is today's agenda. So I will try to start every lecture with questions that student asked me the previous week. So I had 2 questions that students passed along to me, and I will provide a response, and I'll share my answers with you today. Afterwards, I'll go over quickly the ungraded problem set. Again, the problem sets are not graded for any, they don't count for anything. It's just for your reinforcements of core concepts that you pick up during class, as well as gives you an opportunity to look at real data for yourself. So for those of you who have done it, just realize that the data set that I'm referring to comes from the IMF. And the International Monetary Fund often change their macro definitions sometimes over time. And that means that the solutions I posted to you online may not correspond exactly one for one with what you see on the website. You may have to dig through the archives if you want to match my data, but the point is it's just for you to get some exposure and experience handling the data and just to draw the same conclusions that I do. All right, so if you look at the data and try to do the homework yourself, just realize that the numbers won't precisely match up with the numbers I present today. That's OK, because on average, you will draw the same conclusions, OK, despite having definitions that change over time. All right, so and the rest of the stuff is just a summary that I'll go over at the end of the class. So let me start with the Q&A. So someone asked me the following question. So these slides are also on Canvas. I posted it late last night, so if you haven't seen it, you can pick it up now. Look at it now. So the question that was posed to me is how are gold peg implied exchange rates sustained? So this is kind of, again, something I explained last week during lecture, but I'm happy to reinforce the concept again here. So, there's basically one mechanism at play here. All right, it's by the no arbitrage condition. As you learned from your other finance classes, this condition is a necessary condition to be able to price certain things fairly, right? Otherwise, speculators would come in and exploit it maximally so that there's no money left on the table. This arbitrage condition requires that we have this assumption maintained. The central banks must maintain their gold convertibility at infinite quantities. So we're not assuming, we're kind of ignoring the possibility that central banks may run out of gold to convert currencies. In that case, you may have, depegging and so forth. But for this condition to hold on average, we have to assume that central banks are more or less have sufficient amount of gold to maintain international trade. Enough people bring their currency to convert for gold and vice versa. So let me give you so I gave you an example during last week, right, in which we have a sudden depreciation of the home currency, right, the domestic currency, in which the exchange rate, which I define as the domestic unit divided by the foreign unit, increases, right? So I'm going to give you this scenario in which you have a decrease in E, in which the home currency becomes stronger than the foreign currency. So here's the example. Suppose you have 1 ounce of gold that costs 1 British pound. That's the foreign currency. Or you can convert 1 ounce of gold to $2 US. All right, so I indicated that the British pound here is the foreign currency, and the US dollar is the domestic currency. So based on these 2 countries pegging their currency to some quantity of gold, you have a natural exchange rate. You can compute this yourself. If you look at USD per unit of British pounds, which I define here as E, it must be equal to 2, right? If there are deviations away from this implied exchange rate, assuming central banks continue to maintain gold convertibility, you're going to have an arbitrage opportunity, all right? I gave you that example last week, right, in which E exceeds 2 by setting it to 3. But let's go over the example in which you have E changing to E1. So suppose that for some reason the FX market sets the spot exchange rate, or the exchange rate to buy British pounds in terms of US dollars, equal to 1. In other words, the US dollar has become stronger. So if the US dollar becomes stronger such that the price of British pounds drops to 1 from 2, here's the following steps necessary or needed to exploit this so that you can make free money. So we start by borrowing 1 US dollar, and we go ahead and buy the 1 British pound at E equals 1. So I wrote E prime because it's different from E, all right? So we buy 1 unit of British pound using US dollars, and we convert it to $2 US. So how do we do this? Well, here are the following steps. We have to effectively send 1 British pound to the Bank of England, exchange it for 1 ounce of gold. So remember this assumption, right? Infinite convertibility of gold and domestic currency at infinite quantities. So I can do this, right? No matter what, right? No matter the quantity. I send the gold back to the Federal Reserve, and I convert that 1 ounce of gold to US dollars, right? So these steps, you don't have to literally transfer gold. You can imagine if you have bank accounts in 2 different countries, you can just tell them to deduct and credit, right? So assuming these 2 steps can, without any constraints whatsoever, you can see we can easily borrow 1 USD dollar and get 2 US dollars out of it, and then return the 1 US dollar that I borrowed from the beginning and have 1 US dollar of riskless profit. Yes? So let me kind of summarize again. So we started defining the setup of the problem, right? We have a gold standard. Every country sets their gold peg to some quantity of gold. Under those circumstances, you must have an implied exchange rate between all currencies, right? In this case in which you have 1 for 1 for British pounds and 1 for 2 for US dollars, the implied exchange rate must be equal to 2. Suppose there is a deviation away from this exchange rate such that the domestic currency, US dollars, becomes stronger. That means you can buy the same quantity of British pounds for less, right? That's why E prime is equal to 1, lower than 2. In this scenario, you can exploit this strategy using the following steps. We borrow US dollars to begin with. We use it to buy 1 British pound in the FX market. Yes, at the cheaper. Now, we have a stronger dollar, so we borrow with a strong currency, and we now buy 1 unit of British pounds. We send that 1 unit of British pound to the Bank of England, convert it to gold, move that gold to the Federal Reserve, and get 2 units of US dollars at the end, right? So effectively, I've converted 1 US dollar to 2 US dollar. If I have, 2 bank accounts at 2 locations and just credit and debit costlessly, then I basically generated 1 excess US dollars for free. All right, so if you exploit these steps, you will get arbitrage profits. So obviously, these steps cannot be exploited indefinitely, right? Because by going through this step here, buy 1 British pounds, you're putting pressure on E prime towards E2, right? Because when you buy British pounds, you're effectively selling USD, correct? So the US dollars is actually becoming weaker as more and more people come in to the FX market to exploit this strategy. So as more people sell US dollars for British pound, E prime must increase towards E over time until literally there's no profits left on the table. So I highlighted this step here to emphasize that the mechanism that allows this arbitrage strategy to eventually force the deviation from E to return back to its implied exchange rate. OK, so again, this is just a review of what we did last week, right? Last week we had E prime equal to 3. But this is a slightly different strategy. But the result is the same, right? Any sort of deviation away from the market implied rate must go back, right? Otherwise, you have free money on the table. Arbitrageurs will come in and push pressure on the exchange rate towards the implied exchange rate. All right, comments, questions on this example? All right, second question. Somebody asked me about a historical question. Why did the US face both inflation and US dollar depreciation under the Bretton Woods system? So let me summarize the Bretton Woods system again. Bretton Woods system is basically 2 layers of pegging. You have one country, the United States, peg their currency to some quantity of gold, right? And you have all the other countries peg their currency to the US dollar. So essentially, every country must conduct international trade using US dollars. So this is beneficial in one sense because this allows every other country, excluding the US, to achieve their external balance, right? If all the countries want to be net exporters, they can, right? You just have one country left over to kind of absorb everything else. That's the US. The downside is because the downside with this system is that it puts a lot of negative externalities onto the US as a country, right? Because not only does the US have to produce enough US dollars to facilitate international trade, which will cause inflation, but also the US cannot maintain their internal balance either, right? They don't have any sort of monetary policy at hand. Because at the end of the day, they have to use the US dollars to maintain global demand for US dollars, right? To support international trade. So this is where the USD appreciation comes from. If everybody wants to boost their exports and conduct a lot of trade volume, they have to conduct all this trade in US dollars. So under the Bretton Woods system, you have a scenario in which the US generates not only a lot of money that causes inflation, right? But also there's another feedback in which people continue to, as the country grows, they have to demand more dollars to satisfy international trade. So you get these two seemingly contradictory results, but at the end of the day, both of these things are not good for the US. USD appreciation, although they can continue to import cheaply, they're not really, this is not really helpful for domestic firms who want to export the goods elsewhere, right? You need cheap currency to incentivize exports. Inflation also is not good for the country either because you don't have price stability. Yes, so that's basically where these two things come from. All right, so so here the final summary is in this bottom point here. So U.S. is forced to be the nth country, meaning they have to absorb all the residual exports, and as you know, this is the post-World War II. So that means the US essentially is importing all the goods and services generated by Germany, the UK, and France, and all the other post-World War countries afterwards. OK. Yes. Comments, questions on this Q&A question? All right, so to just briefly summarize again, Bretton Woods system, 2 layers of currency pegging, US dollar to quantity of gold. Everybody else chooses their current account target, so that, and they do this by setting their pegging their currency to US dollars. And this system is good for everybody else except the US because those countries can satisfy or meet or satisfy their external balance demand, right? They want to be net exporters, fine. The US just has to absorb all the residual exports. This is bad for the US for 2 reasons. One, it inherently causes inflation because the US has to print more money to satisfy international trade. So you get domestic inflation. On the external side, you also get USD appreciation because as international trade increases over time, US countries will demand more US dollars for reserves, right? They have to keep a sufficient amount of US dollars to maintain the convertibility between the domestic currency and the US dollars. USD appreciation is not good for the US because they can't, US companies are no longer competitive on the global market, right? They have, if their currency is too expensive, then nobody wants to buy goods and services from the US. Inflation is also bad, as you all know, okay? So that's again, that's the summary of why we went off the Bretton Woods system. All right. So before moving on to today's lecture, I want to go over the ungraded problem set. So some of you requested that I do that, so let's do that now. So as I mentioned earlier in the beginning of class, this ungraded problem set is not graded. So this is just for your own practice and a chance for you to work with actual data, macro data. And to remind you again, if you do this yourself and you go through the data, just realize that the numbers on the IMF database may not correspond exactly with the solutions that I provide to you. The reason is because IMF changes their definitions of and the classification categories over time, and that's in that way the numbers may not match up exactly, but the conclusions you draw about the economic concepts, however, should be the same. So let's go over the first question of the ungraded problem set. Maybe I should pull it up just in case. All right. So let's just make sure I get the question right first. Okay, so for this question, for the first question, I asked you to prove an additional identity, that the current account can be expressed as a function of private savings minus total domestic investments plus government surplus. So let's do that right now. Right? Let's show that the current account can be defined as, again, private savings. So this is private savings beyond the government, okay? Private savings minus total domestic investments plus government surplus. It's called the government surplus because it's the residual, the positive residual, if it's a surplus, of tax revenue minus money that's spent by the government, right? So you have a surplus if this is positive, and you have a deficit if it's negative. That means the government is not generating enough tax revenue to offset government spending, right? So that's the kind of interpretation of this reformulation of the current account. So how do we prove this? Well, we can prove this with given these three identities that we already seen before last week, right? We know that the current account can be approximated with exports minus imports. So let's just assume this is equality for now. Total savings is defined as private savings plus government spending, which is equal to investments plus the current account, right? This is domestic investments plus investments abroad. If total savings is if we're assuming that this is a net lending country, right? And then finally, government savings is tax revenue minus government spending. So if this is positive, that means that the country is generating sufficient amount of tax revenue to completely overshadow government spending. So how do we do this? Well, we start with total savings definition, and we swap out government savings with this net tax revenue equation, T minus G, right? And then we have this equation, SP plus T minus G equals to I plus CA, right? Very straightforward. And let's just put all the other variables other than the current account on one side. And so therefore, we can just define the current account as private savings minus domestic investments plus T minus G. Okay. So again, the intuition of this reformulation is that this part is private net investments abroad. So just investments abroad by private citizens, and then government surplus at the end, right? So you can already tell from this formulation, you could actually achieve a very, very positive current account if there is sufficient government savings, right? T minus G. If there's lots of tax revenue, despite having a negative private investments abroad, you can still have a positive current account. So the next part of the question asks, what I just said, right? If you have a positive current account, how does this lead to T minus G being greater than 0, or vice versa? How is this possible? Well, this is possible if total government savings exceeds domestic investments minus private savings, total private savings, right? So this leads to the other and vice versa in two ways, right? First way is if you have a very positive, a very large government surplus in which T minus G is very, very, very big, like very, very big from 0. Even if SP minus I is very negative, you can still have a current account if government surplus is very large. The second way in which this identity can be satisfied is if I minus SP is negative. That means there's lots of private savings abroad, right? So remember, I is domestic investments. So if lots of private savings abroad, SP is very, very big, then this expression will be negative. So the point of this exercise is just to verify which one is true. Is for Singapore, is it the case in which Singapore generates a lot of tax revenue that they don't spend, or is it the case in which you have lots of private savings that's not domestic but foreign, right? So I don't list the data here, but certainly I posted in the solutions. You can also check on IMF data, but my conclusions are the following. Basically, yes, it's because of this reason here. Lots and lots of private savings that's actually abroad rather than domestic. All right, so that's the answer. Okay, so it's actually the latter reason why we have why this is possible for Singapore. Okay. All right, comments, questions on that part of the question? All right, the next part asks you to verify that the GDP of Ireland exceeds its gross national income. So you have to pull up some variables and basically compare the growth rates of the GDP and GNI, gross national income. So again, I don't list the data here, but you can verify yourself. You will find, if you look at the data, that the growth rate of the GDP almost always exceeds the growth rate of national income over time. And in fact, the gap between GDP minus GNI is always positive. Okay, so this is, again, explained by faster growth in foreign income. And this is kind of mechanical because Ireland is a tax haven. So lots of countries just book their profits on Ireland, but in fact, most of the profits eventually moved out of the country. All right, so very simple exercise. I think any of you can do it very quickly. All right, the last part of the first question gives you some information, and your job is basically just to translate that into mathematics. Okay, so maybe I'll read it to you first, and then we can just do the translation afterwards. So the last part says, during the 1990s, private household debt in the U.S. has been growing at a faster rate than U.S. economic output, while the ratio of household debt to equity rose from 84% to 105% between 1990 and 2000. At the same time, government deficits prevailed except for a short period in the late 90s. Do you think raising tariffs would have reduced the value of U.S. net imports? Would tariffs have reduced the volume of net imports? So just based on the last two questions, you can already tell I'm basically trying to gauge your understanding of how the current account changes in Q, right? The dynamics interpretation, right? The decomposition of CA into its trade volume component and the value component. But I also give you some additional background, but it's probably not. Its purpose is not to kind of trick you or distract you, but just to give you a setting. Okay. So let's interpret the setting a little bit. High household to debt to equity. Well, that just means that they don't have any savings. Most of the money is locked up somewhere. So low private savings, and it's actually leveraged investments because its debt actually exceeds the equity value. So it's clear that SP minus I is negative, right? No savings whatsoever. Government deficit, the term, right? This is obvious. They're spending more than their tax revenue, so T minus G is negative. So if you were to write their CA into EX minus IM, and then replace IM with Q times EX star, right? This expression just converts domestic imports as foreign exports, and then convert its currency value. It's going to be negative, yes? So the question is, if you impose tariffs, how does that have an impact on CA? And I think they say it goes down, but in fact, I think the value of U.S. imports actually increases, right? How do you see this? Well, if you impose tariffs, that's effectively raising the foreign prices from the domestic point of view, right? So which actually increases Q. So the value of U.S. imports actually increase, right? If you're, yeah, because they're importing abroad, right? So most likely they will substitute away eventually. But that's the substitution effect, which I describe here, right? So increasing Q increases EX and decreases IM. So the bottom part is the substitution effect from the trade volume. But if you just looked at price levels, it's clear that P star is increasing, right? Foreign imports is increasing, and as a result, your net exports, net imports values are actually increasing as well. Okay, comments, questions on this last part? All right, part 2 of the problem set is just forces you to think a little bit about the nth country problem that I talked about last week a lot. I asked you to use some combinatorics, but this equation you should hopefully seen in your high school class, math classes, okay? So I asked you how many unordered country pairs can you make from n countries. So from a combinatorics point of view, I'm just asking you to choose n choose 2 combination, all right? This is the formula. You memorize it or not, it's up to you, but you should know it, all right? If you calculate these equations to this most reduced expression, this is probably intuitive, right? N times n minus 1 is the number of permutations, right, for pair of two things. And then divide by 2 just cancels out the double counting, right, because you don't care about order. So based on this coefficient, the number of country pairs or exchange rates is n times n minus 1 divided by 2. And the subsequent question I ask you is how many independent exchange rates are there? So independent exchange rate just means that it's an exchange rate that one country can unilaterally set, right, ignoring all other countries that they trade with. So my suggestion is just to think about the 3-country case. So suppose you have, 1 country, 2 country, 3 countries. Maybe I'll just use let me use the circle here. You have 1 country here, 2 countries, 3 countries. Let's just write US, UK. Let's do Australia, okay? So I think it's clear that if you want to make an exchange rate between US and Australia, let's just assume that Australia just unilaterally sets an exchange rate to US, okay, to satisfy its external balance, right? Whatever the current account target they want, they just set it unilaterally to US. Fine. US wants to also adjust its exchange rate to meet its current account target. They can. They just do it with the other country, right? But can UK do the same to the US or Australia? No, right? So there's one country that can't do anything because there is an implied exchange rate between UK and AU, Australia, through these two sets of exchange rates, right? So there is this is implied exchange rate. Correct? Yes? So based on the 3-country scenario, you can already see that if we allow countries to just daisy chain offload their exports or imports onto the subsequent country, and the country has to find another country to offset their trade surplus or trade deficit. There's one country that can't do anything, right? One last country that can't do anything because there is an implied exchange rate that's already determined based on 2 sets or several sets of exchange rates. So as a result, there's n-1 exchange rates that can be independently determined, and the nth country, in this case the UK, just has to take it. So this is kind of like a mathematical characterization of the Bretton Woods system, right? Again, imagine you have countries just daisy chaining each other through the exchange rates. Every country just offloads their their exports or imports onto the next country until you're the last country in the chain. They can't set a different set of exchange rate with any other country because there's already an implied exchange rate set by all these other unilaterally set independent exchange rates. All right. My description of the pros and cons of the Bretton Woods system I already answered in the Q&A question 2, so I won't reiterate here, but I think that's clear already. Okay, I think this is the last question. This last question is just a review of your understanding of the price specie flow mechanism, as well as the so-called rules of the game that's defined by Keynes. So to summarize what the price specie flow mechanism is, it's a way to maintain the current account targets of all other countries in equilibrium. So suppose all countries are already in equilibrium, everybody's current account target is satisfied. If there's a deviation away from it, price pressures, because of the import or export of gold, will cause a reversal, right, in gold flows. And at the end of the day, afterwards, everything's settled. Gold flows are netted out, right, and the current account also returns back to its original stable, ideal targets. Yes. So that's the price specie flow mechanism. The mechanism comes from changes in prices because of gold flows. And these changes in prices will cause reversals in prices and reversals in gold flows. The rules in the game, however, is like a meta game that you play on top of the gold standard. So it's a way to kind of substitute gold flows with just simulations of inflation that's caused by gold flows. So in the case of gold imports, for example, which causes inflation, Keynes suggests that countries simply just simulate the inflation through monetary expansion. Monetary expansion is printing money, but it actually requires countries to buy assets and swap those assets for currency. All right, so that's monetary expansion. In the reverse, when you have outflow of gold, you have deflation, right? You can simulate deflation by monetary contraction. That requires you to sell assets, so you're removing currency from the system. Yes, so the answers for this question is basically just to describe what the US does and what other countries do in the case of the price specie flow mechanism and the rules of the game as defined by Keynes. Okay, so I just did one way. You can obviously describe the other way as well. So to summarize again, gold flows in the case in which you have import of inflation caused by gold imports, you will get inflation. Inflation causes the price ratio to change, right? And people will have domestic citizens will have incentives to substitute away from expensive goods to cheaper goods, and as a result, you get more imports after a import of gold. Yes, and that will reverse gold flows. And the current accounts will also return back to its ideal levels again, right? CA star. So that's price specie flow mechanism. Rules of the game, Keynes. The rules of the game under Keynes. Instead of waiting for gold to arrive to cause inflation/deflation, you simulate it through monetary expansion or contraction. That's it. Okay. All right. So that's the summary overview of the solutions for this week's homework, comments, questions. So again, I hope it's just review of concepts that you saw last week, and again, give you a chance to look at data. That's it. All right, cool. So let's move on to today's lecture. So today we're going to start attempt to begin our model to price foreign currencies using an interest rate parity. Okay, so we're going to start with the financial markets first, and then we're going to try to link financial markets to the real markets later. So, and when dealing with the financial markets, we're going to start with the FX markets, in which we rely on the law of one price or the no arbitrage condition to find a proper price for the for the exchange rate. Okay. Then we will try to link exchange rates to interest rates in the next, not next week, but the week after that. Okay, and I hope it's clear to see how interest rates and exchange rates are intimately linked. Well, if not, then you will soon be convinced. So that's what my job here is today, and also go over some very brief overview of the institutional details of the FX market, which may not be relevant if you're not going to be an FX trader, but anyways, I'm just going to go over it briefly to give you some background, but it's not relevant to, it's not that important for pricing the currency. Okay, so what I think it's important to kind of remind ourselves what our objective here is. So our objective here is to basically, from the perspective of investors, understand where foreign exchange rate risk comes from. If I'm trying to invest in a company abroad or start a business or in another country, one important thing I have to keep in mind is I have to convert my profits back to my home country currency, correct? And it's important to understand what sorts of variables will affect FX rates. And so I'll give you some scenarios to think about from the perspective of corporations / investors. So these are economic activities, macro shocks that occurred in the last few years. Hopefully you've remembered. So fiscal cliff, for those of you who are from the US or from European countries, you may have some discussions in which there's a budget shortfall because your politicians passed a bunch of spending bills and they didn't realize that they have to actually increase borrowing to finance these expenditures. And so when you have a fiscal cliff, you may have to, at the end of the day, cut government spending. So the question I ask you is, how does government spending affect FX rates? Yes? Number two, quantitative easing. So quantitative easing is an old monetary policy tool that has been used since Japan went into a recession back in like the early 90s. Okay? But the US picked it up in 2008 during the financial crisis. What is quantitative easing? Quantitative easing is the purchase of domestic securities and swapping them out for currency. So in other words, you're injecting liquidity in the system so that borrowing is much easier. So how does borrowing money, allowing the borrowing of money to be easier, affect FX rates? That's something you should also understand from the perspective of international investments. Third, Eurozone crisis. So this is a default risk. So back in, again, 2008, 2009, we had several European countries on the verge of collapse because people didn't believe that these countries would be able to pay back their loans. So how does changing credit risk at the firm level impact FX rates? How does that curtail your incentive to make investments in that particular country? And lastly, economic slowdown. So a lot of talk about lots of supply chains moving away from China to other countries, and people are questioning whether or not China's GDP growth targets are going to be met. So if you have a consumption shock or supply chain shock, how does that affect FX rates? So all these questions, I hope to build you a framework to kind of analyze this. Okay, and if you kind of think it through, what these 4 bullet points or these macro shocks have in common, the common variable across all of these macro shocks is interest rates, right? Quantitative easing is about buying and swapping, changing the supply of money in the system, right? If you're changing the money supply in the system, you're going to change interest rates. Fiscal cliff. Well, you have demand shock, right? You have lower government spending, that's going to change the demand for currency. And with different currency demand, you're going to have different interest rates. Eurozone crisis, default risk. What happens to interest rates when there's default risk? It increases, right? Investors demand more returns for more risk. And lastly, potential slowdown in economy. Same thing. This is going to directly impact the demand for currency, right? And as a result, international trade. So all of these variables or macro shocks will be linked to interest rates eventually, and you'll see it very easily this week and also in the next 2 weeks. Okay, so institutional details. So basically, the currency markets has two parts to it. There's the spot market, which people actually trade the currencies, the raw currencies for other currencies. That's roughly around 30 to 40% of the market. And the 50 to 60% of the market, or yes, 50 to 60% of the market is derivatives on currency. In other words, more specifically, we're talking about forwards or futures contracts. So I'll talk about a forward contract in detail in the next few slides, but essentially a forward contract is a promise to buy a foreign currency sometime in the future. Okay, so the spot market is the immediate purchase or sale of a foreign currency. That's, again, roughly 40% of the market. The other 60% is about future exchanges in the future, future currency purchases / sale in the future. So just based on this description of the market, you can see that most of the players in the FX market is trying to hedge currency risk, right? The one way to do that is to rely on these derivatives, these forward contracts, to lock in certain prices ahead of time. Yes? OK, so those are the two basic markets in the currency market. It is dominated by major banks and specialized currency dealers. And they are completely OTC, okay, over the counter. That means that if you want to buy or sell certain currencies, you have to find a counterparty yourself. So it's just a network of banks / dealers that you have to make these transactions on. It's not centralized like the stock market. It's not centralized like futures market. This is all done. In a disaggregated way with binary connections. So if you are a retail investor and you want to have access to the FX markets, you have to find either these major banks, such as, I don't know, HSBC, or one of these specialized currency dealers like those trading platforms. Trading takes place over 24 hours for 5 days a week, nonstop. And these transactions typically exceed over $1 trillion a day. Okay, so that's just a brief summary of the market. Quote conventions. So the easiest way to understand what you need to know about quote conventions is to just pull up Bloomberg. So let's just pull it up. So I pulled up a currency exchange rate from Bloomberg. So I typed in USD HKD : currency. So the last part is not so relevant, but the quote convention I'm concerned with is this part. So USD HKD are quote codes used internationally across countries and every market, essentially. Okay, standard quote conventions in Bloomberg and other trading platforms is they put the currency that you want to buy first. Okay, so I want to buy US dollars, so that's why it's USD first. But in terms of Hong Kong dollars, that's the second part. So reading from left to right, you put the currency you want to buy or sell first, and then the currency in which you want to price the currency at. So here I want to price US dollars in terms of Hong Kong dollars. And so the quote that you're given, therefore, is going to be in terms of Hong Kong dollars. So just to convince ourselves that this is true, let's try another one. Let's try USD in terms of euro. So I expect it to be less than 1. Yes, it is. So again, the first code here, USD, is the currency I want to buy or sell. The next 3 letters, EUR, is the euro. That's the currency I want to, that's the price, that's the type of currency I want to use to pay for US dollars. Okay, so right now, the euros is stronger, relatively speaking, to the USD because it's less than 1 to 1. I can buy more than 1 US dollar given 1 euro. All right, so yeah, let me reinforce this idea. So sometimes in this class, I will write colon. Sometimes I will write a slash. sometimes I just have nothing in between. But they should be read the same way. So I know it may be slightly different convention than I used last week, but starting from today, I will do my best to just stick with this convention. So remember, whenever I write it this way, I mean I want to price x in terms of y. If you want to write it in a fractional form, it means this, right? So x is the unit, is the currency I want to buy, and y is the price I want to buy those currencies in. So the example I gave you was USD HKD. X units of USD is in the denominator. Y is Y units of Hong Kong dollars. Terminology. X is sometimes called the base currency. It's the currency to buy or sell it at. Okay. Y is sometimes called the quote currency, because again, it's the price that you quote it at. So more examples, just to make sure everybody's on the same page. People outside this class may write it in terms of this, so they use dollar signs and euros. I won't. I will use these currency codes. Okay. So if you see this expression, to translate it to the way we're going to do it in this class, we're going to rewrite it in this way. Because euros is in the denominator, it's the currency we want to buy or sell it at. So we write euros first. What currency do we want to use to buy or sell it? We want to use US dollars to buy or sell euros. So US dollars is the next code to the right of euros. So 1.25 means that the price of 1 euro is 1.25 US dollars. So here are several ways you can read this expression. 1.25 US dollars per euro. 1 euro buys 1.25 US dollars, or the price of euro in terms of dollars is 1.25. Yes. All right. So what are so I wrote minor currencies. So what are the major currencies? The major currencies is just the currencies that often are quoted as the base. Okay. Like USD, Hong Kong dollar, US dollars is the base currency. So typical base currencies are USD, Euro, British pounds, also Japanese yen, Swiss francs, as well as the Australian dollar, maybe even Canadian dollars. Okay. Minor currencies are these everything else. Okay. In practice, there should be an exchange rate for every combination of current countries out there, but in reality, that's not going to happen, because a lot of times there's too few people in that country to make it worth the bank's while to establish an exchange rate. So what you have to do is you have to exchange two sets of currencies to get an implied exchange rate. Yes. So this is why US dollars is oftentimes, US dollars, British pounds, Euro, Japanese yen are often called the vehicle currencies, because it's the currency you have to go through to go from one currency to the other. So an example would be if you want to convert Korean won to like a Brazilian real. That exchange rate doesn't exist. I don't think you can find a quote for it. So you have to convert Korean won to US dollars, and then US dollars to Brazilian real. Okay. All right, more practice. Yeah, so here I think this is I already gave this to you as in the previous slide, so maybe let's move on. So let's practice with this. So let's just go over it together. So reading from left to right, the first currency is the base currency. Base currency is the currency you want to buy or sell. So this is the base currency. The currency you want to use to exchange the base currency is the quote currency. So how do we interpret this quote? Let's do it here. So one way to express this is 1 euro costs 1.3 US dollars, right? It's a bit too large. 1 euro costs 1.3 US dollars. Okay. Another way to say this is you can sell or buy 1 euro for 1.3 USD. Another way to say this is 1 euro costs 1.3 US dollars. Yes? So one's in terms of cost of the euro, one's in terms of buying or selling this asset, the foreign currency, in terms of your domestic currency. Another one is, well, I think I'm repeating myself. Maybe just use the word exchange. Sorry. All right. They all mean the same thing. Okay? For the bottom example, let's just practice here again. One, you can. Sorry, I wrote this. I got a swap. My bad. So same thing, just swapping out the numbers, right? Or just and the currency. So here we have 1 USD costs 0.77 euros. You have you can sell or buy 1 USD for 0.77 euros, or you can exchange 1 USD per 0.77 euros. Right? So sorry, I got it swapped. Reading my notes backwards. Okay, so here, base currencies, for the bottom example, review again, base currency is euro. That's the currency you want to buy or sell it at. USD is the price you want to pay for it. So 1 euro costs 1.3. You can buy or sell 1 euro for 1.3, or you can exchange 1 for 1.3 US dollars per 1 euro. Same idea here, but now we're switching euros and USD, right? So the base currency is now US dollars. You want to price it at 1 US dollar for 0.77 euros. You can buy or sell 1 USD for 0.77, or you can exchange 1 unit of USD per 77 euros. They all mean the same thing. So let's do an example with converting the currency price of a liter of gasoline to gallons of gasoline. So I have to do two types of conversion here. Right? I have to convert liters to gallons just to practice unit conversion, and we have to convert euros to US dollars. So let's just go over that now, just to practice. So we start with 2 euros per 1 liter, right? That's the price of gas in France. Now let's convert that liter to gallons. So 1 liter of gallon. 1 liter per 0.26 gallons. Right? That's the conversion rate for gallons to liters. And then let's convert that to 1.30 euro USD 1.30, right? So this again is the price of euro in terms of US dollars. Yes, so euros in the denominator here, euros cancel out with euro in the numerator here. Liters is in the denominator, this is in the numerator, so liters cancels out. So the final units is 10 USD dollars per 1 gallon, right? So this is how you keep track of your units. So hopefully this is just like review of chemistry, or chemistry, right? Keeping track of your units. Comments, questions on institutional details, currency quote conventions. So to summarize, going forward, we're going to rely on this quote convention. So whenever I write exchange rates, I will always write it in terms of this format. I will write the base currency first. The base currency is defined as the currency I want to buy or sell it at. The quote currency is the pricing unit for the base currency. All right. So when I write E, just note that if I wrote E, some number, and then this exchange rate, that's what I mean. Okay. The reason why I'm working this way is because I want to be consistent in my notation, and also I want to define the asset that we're trying to price as the foreign currency. So that's why it's always in the denominator, right? I'm going to write the denominator first. So let me remind you here. E is going to always be defined as domestic divided by foreign. So what that means is that this foreign refers to here, these currencies here, and domestic are referring to here. Yes? Clear? So there's another slide that explains why we do it this way. All right. You may think, why don't we do it the other way? Well, some countries do it the other way, and there's a reason for it. But in this class, we're going to do it this way because we care about prices. Yeah, we care about prices. All right, so it's important to kind of review what bid-ask quotes are. So I think you've taken some of you have taken some trading workshop where you have to read bid and ask quotes. Well, bid and ask quotes are also important in FX markets. If you go to a market maker to buy certain currencies, they will give you two sets of quotes. And it's important to make that distinction because when you do an arbitrage strategy, you have to decide whether to use the bid or ask quotes to formulate your strategy. Okay, so let me summarize here what bid price and ask prices are. Bid price is the price at which the market maker is willing to buy something from you. Okay, in this case, foreign currencies. The ask price is the price the market maker or the dealer is willing to sell it to you. So that's from the perspective of the market maker. So these definitions of market maker. All right, so this may not be intuitive for some of you. And so we can actually think about bid and ask prices from the other side, from the perspective of the person going to the market to conduct exchange. What do these prices mean? Okay, so if I want to go up to the market maker and I want to sell something, which price can I sell it at immediately? Can somebody tell me? If I want to sell, if I take a unit of foreign currency and bring it to the exchange, and I want to sell this unit immediately, which price can I sell it immediately at? The bid or the ask? Sorry? Well, I didn't tell you what the market price is. There's two sets of prices, right? Sorry? Yes, the bid price. Yes. So the intuition is the following: you can, if you want to liquidate something immediately, you can only sell it at the lower price, right? That's how you get rid of something immediately. So from the perspective of the person coming to the market maker, you can only sell something immediately at the lower price, the cheaper price. If you want to buy something immediately, you have to buy at the more expensive price, the ask price. So yeah, so maybe that's not clear. I have to tell you that bid price is greater or equal to ask price, right? If that's not clear. All right, so summarize again. I'll write it here. From seller, from investor, from trader's point of view, you buy at the expensive price. That's the ask. And sell at the cheaper price. Okay, so let me review again. Bid and ask price. Two sets of prices. One low price, one high price. Doesn't matter if it's a stock, or bond or any other commodity. You will get two sets of prices when you go to any exchange. From the market maker's perspective, the bid price is the price the market maker is willing to buy something the trader at. The ask price is the price the market maker is willing to sell something to the trader. Okay, which makes sense, right? They want to buy something that's low, and they want to buy something that's cheap, and they want to sell you something that's expensive. Oh, sorry. Yeah, my bad. Yes. From the perspective of the trader, it's the reverse. If you want to buy something, you can only buy something immediately at the ask price because it's the more expensive price. Conversely, if you want to sell something, you have to sell it at the cheaper price. Of course, if you're a trader, you may be able to, exploit momentum trading or something. But assuming you're not doing any sort of that strategy, you want to execute your trading strategy immediately, then these are the prices you can only buy and sell at. Okay? And you want to do it as quick as possible, then you have to do it here in this fashion, right? Buy more expensive and sell at the cheaper price. So what you typically see in newspapers, textbooks, news media, those currency quotes you see scrolling underneath the TV, it's not quoting the bid price or the ask price, it's actually quoting a midpoint. Okay? So that's just the average between the bid and the ask. And as you can imagine, very, very liquid markets, the bid and ask price the difference is only like less than a cent. Okay? But for very illiquid currencies, the gap can be very large. So bid ask spread is a measure of liquidity, okay, essentially. Okay, comments, questions on terminology, institutional details. Otherwise, we will dive into pricing currencies and arbitrage strategies. Okay. So let's review a bit. Exchange rates, intuition. As I said, I gave you examples from last week. The role of exchange rates is to facilitate international trade, so not only for goods and services, but also for financial assets. So the currency exchange rate is a representation of essentially the entire entire economy, right? Because it's as if you have to use the exchange rate to convert commodity prices, financial asset prices, as well as services and so forth. Okay, literally everything is based off of exchange rates. So naturally, there is more than one asset implicitly behind exchange rates, and but it's the way it's determined, however, should be the same way we price every other assets in finance, right? Through its opportunity cost, its cash flows, and the opportunity cost of currency is directly linked to interest rates, bank deposits. So that's what we're trying to do now. We want to kind of start by thinking about a trading strategy that's essentially risk-free, requires no investments, but it ties exchange rate returns, foreign currency returns, and interest rates between two countries. So this is the principle we're going to be relying on to start our formulation of to price foreign currencies. So okay, so I kind of already I gave you an example in the first week, so I won't go over here. But this is the same idea. So if you have, how do you get foreign exchange prices? How do you get foreign exchange rates from two sets of prices between countries? Well, you take the ratio. Okay, so this is an example using European cars. This is an example using British bonds. So something I went over last week. So, terminology I want to emphasize here that I will use consistently throughout this course. When I say a currency is appreciating, I mean that that means that the foreign currency you're trying to buy requires fewer dollars. Okay, so let me say that again. The domestic currency is said to be appreciating if it requires fewer dollars to buy it. So the way we define it in this class, again, we define it in terms of the price of foreign currencies, right? That means E is equal to domestic per foreign. If we have an appreciation of the domestic currency, that means the numerator is shrinking as the foreign currency units stays the same. Correct? Same quantity of foreign currency, but it requires fewer units of the domestic currency. So when I say domestic currency is appreciating, it means that E is going down, right? So the reason why we formulate E in this way is because we want to emphasize prices. Prices of what? Foreign currencies. Conversely, when I say a foreign currency is depreciating, when a domestic currency is depreciating, we mean that E is increasing, right? Because for a fixed unit of foreign currency, I require more domestic currencies to buy it. This is depreciation. Okay? Just terminology. So if we want to write depreciation in terms of asset returns, we can. Appreciation means the foreign currency returns is decreasing, right? That is, returns in holding onto foreign currency is decreasing. The opposite for depreciation. Returns in holding onto foreign currency is increasing. Just terminology. Okay, we're just swapping returns for appreciation, but still the same idea of asset returns. More intuition. So I'll just read this out aloud then. Okay, so appreciation of USD, fewer dollars needed to buy the foreign currency, lower relative price of imports, higher relative price of exports, right? That just means purchasing power of USD increased. According adjustment of fixed exchange rate would be, okay. So this is just saying that when you don't have a floating currency, there's a different terminology. Appreciation corresponds to revaluation. You don't have to worry about this now. We will get to it later. But this is, again, giving you the terminology ahead of time. The reverse for depreciation of the home currency. In this case, I just use US dollars. More dollars needed to buy the foreign currency, higher relative price of imports, lower relative price of exports. Again, it means that purchasing power of the US dollar is declining. And for fixed exchange rates, it's not called depreciation, it's called devaluation. So a lot of times I think people say in the news, revaluation of Chinese yuan. That's because the Chinese RMB is kind of, it's a quasi-fixed exchange rate. So that terminology, I think you can apply that terminology in that scenario as well. Yeah. So if you don't know, Chinese yuan is actually it's a moving band, and it's pegged to a basket of currencies. Same with Singapore. Okay. So it's not a free floating currency like the U.S. dollar, British pound, or Canadian dollars. Okay. All right. So as I already emphasized the way we formulate E, the exchange rate, domestic over currency, we do it intentionally because we want to emphasize that we're pricing a foreign currency. So that means that when we look at the direction change of E, E must go down to indicate an appreciation of the domestic currency because it costs less to buy that asset. But in other, I guess, depending on the country as well, they have other kind of, there is a different way to look at things. So sometimes you want E to move in the direction like prices would. Some other want to relate the direction of movement of E with trade flows, right? So in that case, you would put the domestic currency in the denominator. So if you want to focus on flows in which E changes in the direction of flows, then you can put the domestic currency in the denominator, and therefore a rise in the exchange rate quote would lead to a HKD appreciation. Okay, so I'm just letting you know that there is this way of looking at things, but we're not going to be working with this. Okay, so you can cross this out. We'll just be focusing on this. Okay, we're going to be working only this. Okay, I don't want to confuse people in this class. Okay, so I think I've already mentioned this information to you. So let's just look at some more data before we go into the model. So this is, I know this is quite old data, but it pretty much is the same today. Okay, so these are where foreign exchange rates takes place. Most of the trading takes place in UK, primarily because most of bank lending takes place in the UK. But this could change very much going into the future. As you know, the LIBOR is being retired, right? I think everyone here should know. LIBOR is being retired. So this could change. But historically, most of the foreign currency exchanges have been conducted in the UK, primarily because all banks lend to each other at the LIBOR rate in the UK. Second most actively traded currency is, the second most activity is US, that's New York City. Third is Japan since 2001. But if you look at today, Japan has been regulated to, I think, number 5. So the next two currencies are also Asian, which is Singapore and Hong Kong. So Hong Kong is number 4. Okay, so I talked about vehicle currencies in the previous slide. So here's a breakdown of what the proportion of currencies are being used as an intermediary to connect to other countries. So not surprisingly, US dollar is the de facto reserve currency, the currency that's being used to go from one currency to another. Even though this is 2001, it looks the same today. Okay, so US is number 1, Euro is number 2, Japanese yen is number 3, British pounds 4, and everything else. The reason why I chose these two is because there's a transition from the German Deutschmark to the euro. Okay, so you can see that Germany plays a big role in Europe, and they still do. All right, so let's get started with the with the model. So to begin, I have to introduce to you two types of exchange rates. The first exchange rate is the spot exchange rate. As mentioned before, the exchange rate is a literal conversion of one currency for another today. Okay, so at time zero. So if I bring US dollars to the FX market and I buy something, I'm buying it today. The other type of exchange rate is called a forward exchange rate. This is a standard forward contract. This is a promise to make an exchange between two currencies sometime in the future. This can be 1 week, 3 months, 6 months, 10 months, maybe even 5 years, okay, depending on your investment horizon. But these contracts typically exist out to, I think, 5 years, and then beyond that, you have to find some special dealers to work with. Okay. Okay, so this is important because, again, the objective is to come up with a trading strategy that links FX rates, or foreign exchange rate prices, and interest rates that eliminates all risk. And there's two sources of risk to think about. One is the risk in which you have to make the exchange today. So we want to eliminate the spot exchange rate today. That's why we're working with the spot exchange rate. The second type of risk is future FX risks, right? Because when you do this trading strategy I'm going to tell you, you have to do two sets of currency conversions. And you want to eliminate fluctuations of the currency in the future. And therefore, you have to engage in a forward contract in this trading strategy. So the key idea that we're going to use to price our foreign currencies is this last bullet point here. The foreign exchange market is in equilibrium when deposits of all currencies offer the same return at all time horizons. So the two key points I want to highlight is same return. Well, same return requires the same currency denomination. So there is currency conversion involved in this strategy. And second, across all time horizons. So this must be true for any maturity of deposits. Okay, this trading strategy there should be no arbitrage possibility for this trading strategy. Doesn't matter how long your investment horizons are. Okay. So I give you this example here. This example is not the trading strategy that's relevant to it's relevant to the FX market, but it's not really relevant to the foreign currency return. So this example I give you here is just stating that there should be the price of currency should be the same. Doesn't matter where you buy it from. If it's in New York or London, it should always be the same price. And the reason is because, again, you can always buy low and sell high, right? It doesn't matter which order. So the example I give you is, suppose you can borrow 1 British pound and sell it for 1.6. That's one way. Or you can borrow 1.59 US dollar and buy British pounds. Right? Either way, either direction will give you arbitrage profits. So maybe it's helpful if I just went through the steps. Okay. So the point of this bullet point is saying that should only be one single price of foreign currency across all markets. And you can do this in two ways. So let me give you the setup here. The setup is the following. Suppose New York City is selling British pounds at the price of 1.6. And suppose London is selling pounds for 1.59, right? Law of one price tells that this cannot be sustained for obvious reasons. And here's one strategy to exploit this price difference. you can borrow £1 and sell it for 1.6 USD at New York City. And then you can buy £1. Sorry, buy £1 for 1.59 USD at London. And then you will get, after returning £1, you get 0.01 USD profit. Correct? So here we're selling high and buying to cover, right? Buying to cover low. So you borrow £1, you sell it for the expensive price in terms of US dollars. Use that US dollars to buy low to cover your borrow, 1.59. The difference is your riskless profits, assuming this is all executed instantaneously. Another way to do this is to borrow the US dollar. So here are the steps. Borrow 1.59 USD and buy £1 at London. You can sell that pound for 1.6 at New York City, and then you can return 1.59 USD, and you get 0.1 USD profit, right? 0.1, right? Okay, here is sell high and then buy to cover. Here is sell low and, buy low, sell high. But just different currencies to start with. But anyways, this should be obvious, right? I gave you an example last week, right? But anyways, this is what we're trying to head towards. We want to kind of formulate something like this to get free money and then establish a relationship based on that trading strategy. Okay? So just based on these steps, it's obvious that these two steps, buy £1 and sell £1, should converge those two prices, right, across the markets. Same here. You're selling in New York City, but you're buying in London. So these are opposite forces, right? But they're all converging to a single price. Okay, so to summarize the mechanism we're trying to exploit, we want to price foreign currencies under the scenario of no arbitrage. Okay, so no arbitrage, this is the, I guess, a formal definition. There cannot be free lunch in the market equilibrium. A free lunch would invite speculators. When all prices can adjust freely, speculative activity restores equilibrium at the equilibrium price. And we're going to be focusing on this interest parity first, the covered interest rate parity. And it only requires no arbitrage. Okay? Eventually, we want to get towards here, but we'll get to that. The reason why we need more assumptions is because we want to link to the macroeconomy. All right, so that's no arbitrage, and let me go over this last forward this security, and then we'll take a break. And then the next part, I'll give you the formula for the covered interest rate parity. So as I said earlier, we want a trading strategy that eliminates all FX risks. Two types of foreign exchange rate risk. One is the spot risk, which is the price of the foreign currency today. And the other type of risk is the future price. we can eliminate those two risks with a derivative, namely the forward contract. The forward contract locks in the price today so that you don't have to deal with it in the future. Right? You know what the price is today. So a forward contract is a contract to exchange one currency for another at a future date, but it's a rate that you know today, determined today. So maybe I'll give you a timeline to give you an idea. So suppose you have, can I draw? Oh, I can. Cool. All right, so I have a timeline here, start and end. Let me write time 0. And this is sometime in the future. Oops. Let's call this 6 months. Well, let me see. What do I use here? I use 30 days. Okay. So today, you set the contract price, the price of the foreign currency you're going to buy in the future. So at time 0, you will know what the price is going to be to buy or sell the underlying asset in the future, the foreign currency. But no exchange. Nothing is exchanged at time 0 in a forward contract. Exchange takes place 30 days, in which someone pays for the foreign currency, right, using the domestic currency. So in this class, I'm going to denote the future price, the forward contract price. In other words, the price you're going to pay or buy the foreign currency at as F. So somebody will pay F and will get 1 unit of foreign currency in 30 days. Right? So remember, F and E both are pricing the foreign currency using the domestic currency. Yes? So that's basically what I'm saying, right? The price of the foreign currency that you pay 30 days later that you set at time 0. All right, some terminology I want to present here. A lot of times you will say long forward. So to long something, you're buying something, right? That's what long means in finance. So long forward means you are the counterparty in the forward contract that buys the foreign currency in 30 days. So you are buying foreign currency. That means you are paying F. Short forward. In finance, short means selling something. Short forward means you are selling the foreign currency or delivering the foreign currency in 30 days. Receiving F. All right. OK. Comments, questions on the setup of the variables. So you know F, you know E. We know interest rates, but we're going to denote using R. I will present to you a formula after the break. And we'll talk about how to take advantage of violations of this interest rate parity after the break. Okay. Comments, questions? Left-hand side, 1 plus R, is the domestic return on deposits. It's the opportunity cost of holding on to cash in which you put it in the bank. That's the interest you make off that deposit. 1 plus R star is the foreign interest rate bank deposit. You have to have foreign currency, the foreign currency in those bank deposits, and that's the interest rate you would get over one period. This 1 plus F minus E over E is 1 plus the so-called forward premium. And at this stage, we can think of the forward premium as the expected return of the foreign currency over one period. So if it's positive, if you have a positive forward premium, it means that you expect the foreign currency to appreciate, become stronger. On the other hand, if you have a negative forward premium, you expect the foreign currency to appreciate. So it's the opposite return direction for the domestic currency. A negative forward premium means the USD is appreciating, and a positive forward premium means the domestic currency is depreciating. So, of course, when we do our arbitrage strategies, we'll be working with this formula. But sometimes it's easier to work with a simplified version for comparative statics. So let me tell you where this comes from. This comes from expanding this equation here. So let's just expand everything out. 1 plus r equals 1 plus r star. 1 plus r star plus f minus e over e plus r star times fe over e over e. Okay? Yes? So just based on this expansion, I'm just multiplying it out, right? 1 plus f over e plus r star times, plus r star times f minus e over e. The ones cancel out, so it's simply just r equal to r star plus this return here, right? F, or expected return here, or the forward premium, plus this third term. This term we can assume is approximately 0 because it's a very small number, r star multiplied by another small number. Okay, so in general, when we work with comparative statics or just focusing on intuition, we can omit this last term. So this is where this expression comes from. Okay, this comes from omitting the last term. All right, so as I already said, I want to show you that if this parity is violated, there is going to be arbitrage opportunity. And I'm going to show you to exploit deviations away from this parity in the next slide. So let me outline the conditions for arbitrage. Arbitrage is basically two conditions. One, this strategy cannot have any sort of investments. That means I'm not holding onto anything and expecting an uncertain return. Okay. Number two, without risk. No sources of uncertainty. So no investments, no holding onto an asset, everything's locked in, and there can be no sources of risk, namely spot risk and forward exchange rate risk. We're going to consider two scenarios. One is a positive sign in which the return of domestic deposits exceeds the foreign deposits, okay, after adjustment. Okay, and now I'm going to also consider the opposite. I'll give you an example. But let's go over this first case in which we have a lower return on foreign deposits even after adjusting for its expected return on foreign currencies. So this is the setup. An American investor who borrows 1 Japanese yen from a Japanese investor for 30 days can exchange the Japanese yen repayment that is due in 30 days. So we're talking about a 30-day return bank deposit. And we have an F forward rate that's given. And we're going to enter a contract over the contract today. So F is set today. So let's start by trying to exploit the scenario in which r star, 1 plus r star after adjustment, is lower than 1 plus r. So note that F over E comes from here. So I don't want to confuse anyone. Okay. Yes? I hope I don't need to go any further, right? This is true. F over E is simply 1 plus F minus E over E. All right, so let me outline the strategy. So the intuition is the following. If you have this violation as a so-called carry trader or trader, okay, you want to borrow at the low interest rates even after adjusting for foreign currency returns, and lend out or invest in the high interest rate. That's the idea. So let me say that again. When you see a violation in the covered interest rate parity, which is what this is called, okay, this equation is called the covered interest rate parity. If there's a violation in this that biases or says that the domestic deposit bank rate exceeds the foreign deposit bank rate after currency adjustments, you as a trader will be incentivized to borrow at the low interest rate and lend out at the high interest rate. But remember that at the end of the day, ultimately, you're at the final end of your trading strategy, you are calculating your profits in one currency. So there are several steps that involves currency conversion. So let's borrow at the Japanese yen, right? We're borrowing at the low interest rate. Borrow 1 Japanese yen for 30 days, and we promise to pay back the Japanese yen 30 days from now, 1 plus R, right? 1 unit of Japanese yen at interest rate R star, I have to pay back 1 plus R. So I'm creating a liability at the get-go, correct? Number 2, let's remove spot risk. So I'm holding on the Japanese yen now. Let me exchange it for my preferred domestic currency, which is USD. So I'm going to sell the Japanese yen for EUS dollars, right? Remember, E is denoted as domestic over foreign. So if I'm multiplying E by a foreign currency, it will give me domestic currency. So at the end of this exchange, I will have E units of the domestic currency. Next step, I'm still holding onto an asset. I don't want to hold on to it, so let's lock it in. Let's lend out the E units of domestic currency in the US market, so I'm USD now, for E times 1 plus R, right? So if I deposit E units at a bank over 30 days, I should get some returns. Those returns are E multiplied by 1 plus R, right? 1 period return. So far, so good, right? So I'm borrowing at the low interest rate, lending out the high interest rate, but there's a problem. My liabilities are in Japanese yen, but my return at the end of the 30 days is in US dollars. I have to lock in my exchange rate today for the future. So let's do that. Let's eliminate future risk. So number 4, let's enter into a forward contract, agree to pay F times 1 plus R. This is our liability, right? Let's multiply F. That's the price of the future. That's the price of the future Japanese yen in terms of US dollars for 30 days, and we will receive 1 plus R. So this is a long forward, right? Because we're buying the foreign currency. So note that this foreign currency that we receive will precisely offset this liability, and all we have to do is pay F times 1 plus R star. So up to step 4, 2 things you should notice, right? No investments. I'm not holding on to any assets. No speculation whatsoever, correct? Whether any asset goes down in value or up in value, doesn't matter to me. All my interests returns are locked in today. There's no uncertainty at all. E is known, F is known, and R and R star are all known. This is riskless interest rates, right? No chance of default. So at the end, at step 5, we will receive E times 1 plus R, which is from our investment abroad, correct? Domestically, right? And we pay the price of entering into the forward contract. So if the difference is positive, then we must have risk-free returns, right? Riskless returns. Sorry, riskless returns. I have no investments whatsoever. There's no sources of risk. So entering into this following strategy cost me nothing. Maybe some transaction costs, but as for now, let's assume there's no transaction costs whatsoever. This strategy is virtually riskless, free money. Yes? All right, so maybe I will walk you through this again, but with a table to show you the cash flows today and tomorrow, and show that everything cancels out other than these two cash flows, right? This positive cash flow here and this negative cash flow here. So let me write today cash flow on this side here, and then the future cash flow on the other side. So number one, we start by borrowing 1 Japanese yen. So we have plus 1 JPY. So by borrowing, we hold on to 1 Japanese yen, correct? But we also create a liability of minus 1 plus R star JPY. Correct? That's what it means to borrow something. I borrow one unit of a currency or asset or whatever. I have to return something, right? This is the cost of borrowing for Japanese yen, the bank deposit, right? So we have a minus here because we have to pay it back, and it's denoted in Japanese yen. So this is kind of redundant, but anyways, I put it here to emphasize it's a foreign currency. Number two, I will sell my Japanese yen, so I'll minus 1. But at the same time, I will gain 1 or US dollars, right? That's what buying currency is, right? It's a swap for one currency for another. I'm giving up my Japanese yen, now I have US dollars. So step 2 is nothing, okay, for here. That doesn't change anything in the future. Step 3, I won't make any investments, so let's lend it out. I will lend it out. So that's minus EUS dollars. Today, in the future, I will gain E times 1 plus R. Yes? Step 3 means I'm not holding on to any investments. I'm not holding on to any assets. I'm not making any sort of investments. I'm going to lend it out. So I'll subtract E. But in the future, in 30 days, I will receive returns, bank deposit returns, E times 1 plus R. This is denoted, to emphasize again, in US dollars. Four, no future risk. So engaging in a forward contract does not require any exchange today. So no cash flow changes today. So I'm going to skip it. But in the future, you have to make an exchange. And in this case, because we are long forward, we will be buying the foreign currency, receiving the foreign currency, and paying out domestic. So we will pay F times 1 plus R star. So we carefully chose R star, so things cancel out. Okay, this is in USD. And we will gain 1 plus R star, Japanese yen. Agree? This is the underlying foreign currency amount. We want to receive 1 plus R star to cancel out our initial liabilities, right, that we created in step 1. But we have to pay F times this amount because this is the agreed upon exchange rate that we set, future exchange rate that we set in step 4. Finally, we have, let's let's sum up the total cash flow. Total CF, 0, right? You can see it, right? We have +1 Japanese yen that gets canceled out by step 2, plus E, but we cancel that out in step 3. So total cash flow today is 0. No investments, nothing. We're not holding on to anything. In step 5, will we calculate the total cash flow? That is going to be E1 plus R minus F1 plus R star. And you can see this, right? Minus 1 plus R star is canceled out by this term here. So let's use a different color. So this term here cancels out this term here. And all we're left is this one and these two, right? These two. And they're in the same currency. So if this expression exceeds 0, then you have arbitrage profits. Comments, questions? All right. So let me ask you, in these steps, which step allows this violation to converge to parity? Which step along this arbitrage outline strategy, this strategy outline here, allows the restoration of this parity if it's exploited over and over again, and perhaps in large quantities? Step 2, right? Because you have to sell Japanese yen for US dollars. When you sell the foreign currency, you're going to make the foreign currency weaker, and therefore the domestic currency stronger, right? What does that mean for E? It means E must go down. When your denominator goes down, the entire expression, the fraction, goes up, and that's going to restore parity. So step 2 here, right? This one will make USD stronger, E decreases, covered interest rate parity restored. So if there's a violation at all, it should disappear almost immediately, because everybody's going to try to exploit it. Everybody's going to try to sell Japanese yen for US dollars so they can invest in the higher interest rate. But in doing so, eventually in equilibrium, nothing left on the table, right? So this equation, given E, given R star, should be very, very good at pricing what future spot exchange rate should be, right? So for now, remind you, our objective is to come up with the equation to price F over E, right? This return on foreign currencies. But at this juncture, we're going to just start out by assuming F is locked, right? Sorry, F is going to be the means to, this equation is the means to calculate F, right? So that no arbitrage can exist. So we have to relax some assumptions to make F irrelevant or unnecessary. But that's a starting point for us to start thinking about how to price foreign currency returns. Questions, comments? So I'll go over 2 more examples slowly, just to make sure everybody understands the steps. And I hope that's enough. But I will also give you another sample homework question to work through one yourself. But this is a very, very easy questions to write on the midterm. I just changed some numbers around. And your job is just to come up with an arbitrage strategy. I gave you one direction already, right? The opposite direction should be also quite intuitive, right? If it's the other direction, you need to borrow the lower interest rate and lend out at the higher interest rate, and perhaps engage in a different forward contract. So I'll walk you through an example in the next 2 slides. But are there any questions about intuition, the definition of arbitrage, the difference between domestic and foreign currencies, how to interpret E? I mean, those are the primary takeaways for today. All right, so let's then, if no questions, then let's just move on to the examples. So everything I just said is reiterated over here. Yeah. Let's go through some examples. So as I already indicated in the title of this slide, this is like precisely the same as the previous slides in terms of this formulation. You just have to check which direction is violated and then start outlining your strategy afterwards. So as I indicate, long forward just means foreign currency bank deposits are going to be lower than the domestic deposit rates. So you're going to have to engage in a long forward contract, meaning you have to buy the foreign currency in the future. So that's the hint. But in any case, let's walk through an outline here. So first thing I would do if I saw a question like this is to check which way the parity is violated. So let's check. 1 plus r equals to 1.08. And I'm going to tell you it's greater than, okay, f over e. That's equal to 1 plus 0.12 times 1.53 over 1.6. All right, so I did it once, but I may have did my calculations. There may be an error in my calculations, but somebody just double check to let me know if I'm wrong. So based on just substituting these parameters into the CIP equation, the covered interest rate equation, we already determined that after forex return adjustment, the bank deposit returns domestically exceeds the bank deposit rates abroad. So under those circumstances, we can outline an arbitrage strategy. Let's go through it again. So I'll move it here because I'm going to draw a table again later. So step 1, we borrow. So remember, borrow at the foreign currency. So in this case, before I start, look at the exchange rates that I give you. So in this case, the first step should always be looking at determine which currency is the foreign currency, which currency is the domestic currency. If I give you an exchange rate that's defined this way, I'm pricing British pounds in terms of US dollars, then the British pound or the UK is the foreign currency, is the foreign country. USD, conversely, is the domestic country. So whenever I write R and R star, they correspond to what I just said. R corresponds to the USD deposit rates. R star corresponds to British pounds. Okay, so let me reiterate that again. When you see a question like this on the exam or on your CFA exam, the first thing you should do is to identify how the exchange rate is defined. The exchange rate is defined, in this case, in this setting, as the price of British pounds in terms of US dollars. That's step 1. Once you do that, then you know which side the interest rate should go on. Because the US dollar is the domestic currency, domestic or US deposit rates should go on the left side. Conversely, the foreign currency, in this case British pounds, R star is going to be bank deposit rates denominated in pound sterling. Okay, or you can think of it as deposit rates in the UK. Good? So once we have that knowledge, we can write out the parity, plug in the interest rates corresponding to the countries, whether it's domestic or foreign, and you can determine which way the parity is violated. That's step 2. All right, so now you know which way it's violated based on my calculations. It seems like domestic deposit returns exceeds foreign deposit returns after currency adjustment. Therefore, my strategy should involve borrowing at the foreign deposit rate and lending out at the domestic deposit rate. So let's start out by borrowing foreign. So let's borrow. Let's borrow 1 for 1 year. I think this is 1 year. Yes, 1 year. So trick questions I may introduce to you, okay? This will determine the investment horizon, okay, the 1 year forward rate. So if I write 1 year forward rate here, then you can safely assume that these risk-free rates also are just for the 1 year. But sometimes I may try to throw in some finance, testing your finance knowledge and say, well, this is 1 year, but I'm giving you like a 3-month interest rate. You have to convert everything to the same, investment horizon. That's something I may ask. But in any case, something to pay attention to. So this is a 1 year investment horizon, 1 year interest rates, risk-free interest rates. It's for the 1 year period. So borrow £1 for 1 year and pay back 1 plus R star. Yes? That's what it means to borrow foreign currency, right? We get the foreign currency today. We create a liability that we have to service 1 year from now. Step 2, exchange £1 for EUSD on spot market. So this step eliminates spot risk, right? So now I have US dollars. I don't want to hold on to it. Holding on to it would mean I'm making some sort of investment. I am not. So let's lend it out and get 1 plus R times E in 1 year. So no spot risk, no investment, but at the end of my trading strategy, I have to be working in one single currency. So that means I have to engage in currency exchange one more time if I don't lock it in today. So there's FX risk. How do I eliminate it? I engage in a forward contract. I have to promise to offset my liability here, which is denominated in foreign currency, and receive domestic currency. Sorry, pay out domestic currency and then receive foreign currency to cover my liabilities. So let's do long forward, which means that I will agree to pay F times 1 plus R star USD and receive 1 plus R star in 1 year. So with this forward contract and this exchange that I conducted on the spot market, there is no FX risk whatsoever. I am not exposed to the fluctuations of the foreign currency today or to its change in the future because I locked it in today with some counterparty, assuming the forward market is quite liquid and it's easy to find a counterparty. All right, so finally, you can already see that all my cash flows cancel out with the exception of my investment return, 1 plus R times E, and the payment of F times 1 plus R star. So I receive E times 1 plus R, and I pay F times 1 plus R star. And based on this violation, right, you can tell that I will make profits, right? It's exploitable if the numbers don't change. So let's walk through it again, but let's look at the cash flow today and 1 year from today. So again, starting from step 1, we want to borrow at the foreign currency. So we will receive 1 British pound. And we will return 1 plus R star in the future. Yes, so we created a liability in the future, but we have 1 British pound, 1 unit of British pound currently in hand. Step 2 requires liquidating that borrowed asset to hold on to USD. So that's minus 1 British pound, but we gain EUSD. And there's nothing that happens in the future, right? This is done today. Step 3, we will lend out US dollars today because I don't want to make any sort of investment. I don't want to hold on onto any assets. So let's lend it out. So that's minus EUSD, but we will receive E times 1 plus R, right, in the future. However, because I have to conduct one last currency exchange return exchange in the future to make all my returns into one single currency, and I don't want to be exposed to that risk, so I have to engage in a forward contract. Because I have foreign currency liabilities, I want to go long forward. So let's long forward so that we receive 1 plus R star, but we pay out F times 1 plus R star. So nothing is done today, but in the future I will pay F times 1 plus R star, which is USD, and I will receive 1 plus R star. British pound. Okay, and 5, we can calculate the total assets we're holding on to 0, and at the end we have E 1 plus R minus F 1 plus R star. Right, everything cancels out. Borrowed asset is spent. The borrowed asset generates a liability in the future. We use that domestic currency to lend it out because I don't want to make any investments. And we will receive this amount return in the future. But I'm exposed to foreign exchange rate risk because of this liability here. So let's eliminate it by engaging in a long forward. That means we will receive foreign currency and pay out domestic. Everything cancels out other than these two expressions here, E times 1 plus R minus F times 1 plus R star. So if this equation here is positive, then there is arbitrage strategy, arbitrage opportunity, which we've shown that it's true here. All right, comments, questions on how to do this, approach this question? OK, so it's just a repeat of the previous slide, just a review. So let's do the opposite direction now. All right, let's walk through the steps on how to approach this. Number 1, how is the foreign exchange rate defined? Again, foreign currency, base currency is British pounds. domestic currency is US dollars. Therefore, interest rates, domestic interest rates on the left side of the CIP equation should be US bank deposit rates. Interest rates on the right-hand side should be the foreign currency returns, which are British pounds. So let's check which direction this CIP is violated. We have 1 plus r equal to 1 plus 0.08. I believe it's less than. Again, people should double check my numbers. F over E is equal to 1 plus 0.12, 1.53 divided by 1.58. That should equal 1.105. Right, the 105 is going to be greater than the 0.08, so it's violated in the other direction. So step one, as I said, identify domestic foreign currency. Step that will allow you to determine which interest rates is on which side of the CIP equation. Step two, figure out which way the CIP is violated. Now it's violated in the other direction. What does that mean? You conclude that after currency exchange rate adjustments, domestic deposit returns are lower than foreign deposit returns. And so as a carry trader, arbitrageur, you want to borrow domestic and lend out now at the foreign bank deposit rate. So let's do that now. Step one, let's borrow EUSD on USD and pay E times 1 plus R in 1 year. Yeah, it's clear that we're borrowing USD now, right? Because it's violated in the other direction, and we want to borrow at the low interest rate. So we borrow the currency we want to borrow at, and we promise to pay back this liability, now denominated in US dollars. E times 1 plus R. So to emphasize, E is arbitrary. You don't have to borrow 1 unit. You don't have to borrow E units. I'm only borrowing E units because everything cancels out, reduces to just this equation here, CIP. You can choose any notional amount you want, okay? Just to let you know. Number two, we want to eliminate spot risk, right? We're still holding on the US dollar, so let's now exchange E US dollar for 1 British pound in spot market. All right, so I eliminated spot risk. Now I want to not hold on to the asset, because otherwise I would be making an investment. So let's lend it out. So lend 1 British pound to get 1 plus R star in 1 year. So up to step 3, I've eliminated spot risk, and I'm not making any investments because I'm not holding on to anything. But I'm still, again, exposed to FX risk, right? I have to still make a currency conversion. I have to move all my liabilities and payoffs into one currency, so there's one extra step. And I can eliminate that future exchange rate by engaging, again, in the forward contract, but this time in the opposite direction. I'm going to short forward. I want to receive domestic currency, but deliver the foreign currency. So engage short forward. So I will sell the foreign currency and receive F times the foreign currency. return, right? So this is British pounds. This is in the US dollars. And this is British pounds. So different things are being canceled out now, right? So you can see that this return that I get, I'm going to sell it actually. So it's no longer the liabilities that's being selling, right? It's these two values are being canceled out. But anyways, we'll cover that soon. All right, so finally, what are we left after we cancel, certain cash flows? We're left with this cash flow, right? This receiving the amount in the short forward contract, and we have to pay, right? So we receive F times 1 plus R USD, and we have to pay E times 1 plus R. So let me write pay E times 1 plus R and receive F times 1 plus R star. Okay. So you can see if F times 1 plus R exceeds E times 1 plus R, this precisely corresponds to the violation of CIP in this direction. OK, let's walk through it one more time, but now again with cash flow tables. So this is today cash flow versus 1 year cash flow. So step one, we borrowed EUSD, and we created a USD liability. Step two, we are going to buy the British pound. So +1. And we're going to lose E, right? So we limited the spot risk. Number three, we don't want any investments. So let's go ahead and lend it out. So that means we will lose 1 British pound, but in the future we will get 1 plus R star British pound. Yes? So far so good, right? Probably the forward contract is a bit less intuitive. So in this case, I'm going to tell you we're going to engage in a short forward contract, which means that we're doing the opposite. We are receiving domestic currency, and we're delivering the foreign asset, the foreign currency. So no cash flow change today, but in the future we will receive the price and we have to deliver the foreign asset, the foreign currency. And in 5, we realize that the cash flow today is 0, and the cash flow in the future is F1 plus R star minus E times 1 plus R. Right? And let's just double check that everything cancels out, right? So this outflow of cash from delivering currency, foreign currency, comes from this return, right? So all we are left is this liability, and then this inflow of cash sometime in the future from the forward contract. So in the end, this is our equation, which is precisely the CIP, right? If it's greater than 0, then we have essentially free money, arbitrage opportunity. All right, so I think with these two examples, it should be very, very easy to complete the quiz now. But is there any questions and comments on these last two examples? So, I mean, This will definitely be on the midterm if you're wondering. Just think of ways I can, vary this. I can change the investment horizon. I can ask you to calculate, compound interest. These are all possibilities, right, to make things hard. Yeah, but as long as you follow the steps that I outlined today, for you today, I'll go over it again. You should be fine, right? So the first step, look at the exchange rate. How is it defined? Figure out which currency is the foreign currency, which one is the domestic currency. That will tell you which side the interest rates fall on CIP. With that determination, you can figure out which way CIP is violated. Depending on the direction, right? You either borrow the domestic or you borrow the foreign. You always borrow the lower interest rate after currency adjustment. Right? In the case in which domestic deposit returns exceeds foreign deposit returns, you will borrow at the foreign currency and lend out in the higher domestic currency. In the case in which you have foreign currency deposit returns exceeding domestic deposit returns, you do the opposite. You borrow domestic and you invest and lend out at the higher foreign deposit rates. That's it. Okay? So just remember, I think where people struggle is understanding how to engage in the forward contract. Okay? And it's easy to figure it out, I think, if you just write out the table. Right? You know which cash flows to cancel out and which terms you need to be left over to figure out if your strategy makes sense. Okay, so the last I want to conclude today. Well, I have a set of review slides. So this is the last slide of this set of slides. So this is just to give you more intuition on how to interpret the covered interest rate parity. So the formula I gave you for the covered interest rate parity is for one period, right? As you can see, 1 plus R is just a one-period return. But of course, you can rewrite this in terms of continuous compounding return, and that can kind of give you more intuition. So let's just think about continuously compounded return for both bank deposit, domestic and foreign bank deposit rates, right? We just write it in this format. This is the exponential. Hopefully, I don't have to explain what that is. Yes, so this is the exponential, continuous compounding interest, as if you're reinvesting instantaneously over a period of time. How do you rearrange things so that we're analyzing interest rate differentials? We can take the log of both sides, right? We rearrange these terms. We divide both sides by exponential r star. Then you have the ratio of exponentials, and you take the log. The log of division is minus, right? It becomes minus. The log of multiplication is plus. So log of ratios will give you the difference. So and the log of an exponential will return the variable inside the exponential. I hope I don't have to. I'm not going to prove it to you, but just trust me that if you take the natural log of an exponential, it'll just give you the term inside the exponential. So after doing that, converting this equation to here, you can already see, hopefully, more intuition of what we're trying to say here. We're saying that any sort of interest rate differentials between countries must be precisely explained by the difference or the change in foreign currency returns, right? Log F minus E. This almost looks like log returns, right? So hopefully that kind of gives you more insight into understanding how exchange rates are determined, right? It's precisely actually determined based on interest rate differentials set by countries in a floating exchange rate environment. You can actually see that in this one period example too, right? You can divide both sides by 1 plus r, and just look at the numerator, right? Just look at the numerator here. The difference between r and r star must be explained by, the sign, the difference, either it's positive or negative, must be precisely determined based on whether or not f is greater or less than e. And that's precisely what you see here, right? Whether or not you should go long or go, borrow at which currency returns, precisely tells you what people expect the direction of the currency to go, right? Either increase in value, the foreign currency increases in value, or the domestic currency increases in value. All right, comments, questions on these alternative formulas for covered interest rate parity? Hopefully that gives you more intuition of where we're headed. Okay, so not next week because it's Chinese New Year, but the weeks following, we will try to relax. We're going to try to impose some assumptions that makes locking in this forward contract unnecessary. Okay, this requires assumptions on market efficiency and also about risk preferences of investors in general. Okay, so I don't want to dive too much into it, but those are the two assumptions we need to make forward contract unnecessary, and therefore we get a pricing formula for foreign currency returns. Comments and questions on that last slide. Otherwise, I'll just quickly review, and then give you hopefully 5 minutes left to finish your quiz, turn in your quiz, and then see you in 2 weeks. All right, summary, terminology. When you see a currency quote on Bloomberg, the first currency that's quoted is called the base currency. That's the currency you're going to try to buy and sell things at. Okay, that's the underlying currency you want to buy or sell. At what price or what units of currency you're going to pay for it, that's the quote currency. Another way of saying base currency, quote currency, is also foreign currency and domestic currency in this class. I will always write the foreign currency first and the domestic currency following after it. So British pounds, USD, means that the price of British pounds in terms of USD, but also means that I'm thinking about US dollars, or the US as the domestic country and UK as the foreign country. So some textbooks will use these signs. I think that's confusing if I use more than one way to define exchange rates. So I will stick with this formula as much as possible. Okay. All right. Summary of bid and ask price. So this is important for something I will show you called the triangular arbitrage example. So I'll talk about that later. But to summarize bid-ask prices, you can think of it in terms of the market maker's perspective. The buy price is the low price, the ask price is the high price. The buy price is the price in which the market maker is willing to buy. The ask price is the price the market maker is willing to sell. It's the reverse from the trader's perspective. The trader always wants, if the trader wants to liquidate an asset, it must sell it at the lower price. Okay? So let me say that again. If the trader wants to sell an asset immediately, it must sell it at the lower price that's offered by the market maker. So that's the bid price. If the trader wants to buy an asset, it must buy at the higher price. Why is this important? Well, it's important is if rather than just give you one currency, so remember in those examples I gave you in class, I only gave you one price for the exchange rate. But what if I gave you a set of prices, right? How do you do CIP when I give you a bid and ask price for the spot rate and also for the forward rate? That's something to think about, right? It depends on whether you're buying or selling the underlying asset. So in the example homework I gave, in the ungraded homework I gave you, there's an exercise for you to walk through. But I'm going to go over a separate arbitrage feature in the FX market, which is called the triangular arbitrage. I think this arbitrage is kind of trivial, but textbooks go over it, so I'm going to go over it here. So triangular arbitrage just means that there's actually two sets of exchange rates. One is the explicit exchange rate that's quoted on the market, but there's also an implied exchange rate if there's a vehicle currency involved, right? So what that means is that there is an indirect implied exchange rate, in this case between British pounds and US dollars, or USD is in euros, from this exchange rate here. You can see the vehicle currency is the British pound, right? The intermediary currency. But I can relate US dollars to euros by doing some currency conversions, right? I can exploit these two exchange rates to get an implied quote and compare it with this explicit quote. That's the idea, right? if I have to move through two currencies and get if I have to move through an additional currency, that implied exchange rate has to equal the explicit exchange rate. Otherwise, there's going to be arbitrage opportunity, right? It's as if there's two different prices for the same asset again. So this is also, I see a lot of students struggle with this, so I'm going to outline just my way of doing it, but of course there's more than one way to do this, all right? My way to tackle this is to just focus on two cases. Look at the base currency. The base currency is the currency you can buy or sell it at. So I'm going to try to borrow one of these currencies. So that's why there's only two scenarios. I'm going to borrow one of these currencies and then try to convert it in a circular manner back to USD to see if I come out with more than what I borrowed. Right? That's the intuition. So let me say that again. I'm trying to compare the implied exchange rate with an explicit exchange rate. And the way to do this in a triangular arbitrage sense is try to start with a currency, go full circle back to USD, and see if I come out more than what I started with. Right? There's many ways to check. It may seem like there's a lot of cases to check, but I'm telling you there's only two cases to check. And the easiest two cases to check is to look at the two cases in the base currency. There's US dollars and there's British pounds. So let me walk you through those two cases. So let's start with a case that does yield arbitrage profits. So let's borrow USD. So we want to move to USD to euros. So that's this quote here. Okay? Borrow USD, and let's sell USD for euros. When you sell euros, which quote do you sell it at? The bid or ask as a trader? Yes, bid. See, things are already complicated when you're getting two sets of price. So once you think about that, it should be obvious once you pay attention to the details, it should be obvious which quote to pick. Okay? So borrow one USD, we sell euros based on the bid. And then we have to go and buy British pounds. We always buy at the more expensive price. Yes, the ask. And then we come full circle with a sell British pounds for USD. So I'm not going to go through step by step because I think it's a bit tedious. But I'll let you work through it yourself. Okay, so if we go through this step, we borrow USD, sell euros, buy British pounds, and then come back to USD again, you can literally convert one USD back to something more than 1.005. Okay, but you just have to pay attention. Are you selling or are you buying? You always sell at the lower price, and you always buy at the higher price. Okay, and this strategy has to be executed instantaneously. Okay, and then you can check when you borrow British pounds. Go full circle back to British pounds again. Try to go full circle, right? Going through three currencies. And if you come out with more, then there's arbitrage profits. One other thing you should check is I kind of arbitrarily started at USD. You don't have to. You can start at euros and go all the way back to euro, but you have to follow the same order: USD, euro, GBP. So if you start euro, you can go euro, British pounds, USD, back to euro. It doesn't matter where you start in the chain. You will yield the same result, conclusion. So that's something you can check yourself. OK, so in this case, the first bullet point will give you arbitrage profits. The second bullet point does not. You can double check my work here. All right, so forward exchange rates. So I'm just summarizing. Okay, so forward exchange rates, again, it's nothing exchanged today. Exchange takes place 1 year or 6 months, 3 months, sometime in the future. You are long forward if you are buying the foreign currency in the future. Okay, long forward means to buy. Short forward means to sell the underlying asset. And of course, there's a reversal. If you're buying, you're giving away domestic. If you're selling, you are receiving domestic. And yeah, so the final interpretation I want to emphasize here: returns from interest rate differentials must be wiped out from depreciation of the domestic currency. Otherwise, there is arbitrage. Cannot exist, cannot persist very long. Okay, and it's called the covered interest rate parity because we engage in that forward contract. Arbitrage requires no investments and no risk exposure whatsoever. So as I already mentioned before, we want to relax our assumptions about use of F. somehow, and this requires market efficiency and also specific risk preferences of investors. And we'll talk about that later, but the ultimate pricing model we want to work with is called the uncovered interest rate parity. All right, so I don't want to walk through this again, but this is an example, again, that you saw in your slides, but I color-coded where things cancel out. So take a look at this when you have time. All right, so that's all I have for you today. So there's a few minutes to work through your quiz if you haven't solved it already. But in any case, this is we won't see each other next week, but I'll see you in 2 weeks.